Hey everybody, Courtney Smith here with our February 28th, 2022 edition of Wall Street Winners. Well, it's time for a more dramatic call. So we've been talking about the bear market for quite some time, but I now believe that the market is going to rally significantly, and I'm going to detail why in today's presentation. Let's take a look here at the S&P. After the Russian invasion of the Ukraine, we saw a spike down in the market. We broke below the previous lows, confirming the bear market. The market dropped hard on pretty heavy volume. Now, that doesn't look like it could be capitulation type of volume. It's borderline. But nonetheless, the market then took off and has rallied significantly, closing on the highs even on Friday. Over here on the Dow, we can see once again, and I talked about this a few weeks ago, when we get the selling pressure up in this level, it's unsustainable, and you should expect the stock market to rally, which it did. Now, buying pressure also started to rebound. Notice buying pressure, the little green line, popped up even more than the selling pressure came down. We're seeing a lot of bottom fishing here. And in the NASDAQ, the same thing. Heavy volume. Would have liked it if it was heavier volume, but nonetheless, we closed on the highs on Friday after the big rebound on Thursday. Purple Predictor is a bit bullish. Now, seasonality, this is the IWM, which is the Russell 2000 ETF. And one of the things to see here is we make a low, we make a lower low, but the RSI, which is this green line here, did not. That's a major bottoming signal, and we should see it break above these highs very soon. Now, one of the things, though, is I'm not looking for us to go to new all-time highs. I'm looking for us to go back toward old all-time highs, but not break them. Utilities still neutral as well. Now, this is one of the major reasons why I'm looking for a rally. We're now going into a period of seasonal strength for 2 months. Every seasonal pattern here, it doesn't matter what scenario you're looking at, is bullish. A bit of a dip here towards the end of March, but generally speaking, we're talking about bullish. Now, the market doesn't have to follow seasonality, but by definition, it usually does. As they say, the race does not always go to the swift and the fight to the strongest, but that's the way to bet. So we're going to bet that way. Asset allocation, we started to see money come back into the stock market and out of the bond market. I'm going to talk about bonds more in a minute. I'm changing my opinion there as well. So we're seeing cash supporting the market. A little bit of rebound in risk, not a lot. So they're still going towards the safe sectors of the stock market, not the wild and crazy speculative areas of the marketplace. So once again, more towards Dow and S&P, less towards NASDAQ, but nonetheless, they're going for stocks, not bonds. Global shares really hammered down here on the invasion. Of course, the global shares is dominated by European shares, okay? UK, German, Swiss, French, etc., Italian, Spanish. So as a result, the invasion of another European country shocked the stock market over there, and they collapsed. And then we got what's called an island reversal, a gap down followed by a gap up on heavy volume. That's a perfect reversal sign. It says we should rally at least up into this area over here, and I think down the road we'll break these highs as well. But remember, all-time highs were way back here. I don't think we're going to break those. Now, as I say, I'm going to talk about this more in a second, but yield curve is very stable up here. You can see in the lower left-hand corner, it's very positive at the very short end of the yield curve, but it's pretty darn flat out here. This is not good for the economy. And once and remember, this is based on zero Fed funds, this lower level. So as soon as they raise 50 basis points would put it up here. 100 basis points would put it basically a flat yield curve. that would be extraordinarily bearish. But right now, the market's focused on what's called 2s, 10s, which is the difference between the 2-year note, which is right here, and the 10-year note, which is right here. And you can see very flat. An inversion of that curve would make me extremely bearish and would call for a recession. We're awfully close to that signal. So bonds, I think, are going to start to rally here. And fully paid up members will go into this in more detail. But notice that the purple predictor has completely taken off to the upside. The market has rallied a little bit, not a lot, but the purple predictor is taking off. And some of the advanced analysis that I do for the fully paid up members will support that argument. Now, when I look at our bond key factors here in the freebie section, here's 10-year treasuries right here. They're still in a bull market. Gold, bull market. CRB, bull market. 10-year treasury in Germany was a bull market until a few days ago. I think this was going to be the one that's most critical to start bond yields starting to move a little bit lower. Not a major bull market in bonds by any means, but at least a retracement on the bearish move that we've had since the beginning of the year. The dollar spiked up on a flight to safety, and then it gave it right back up again. Right now, I think that the market is not expecting to see an acceleration of the war in the Ukraine. I think what the market is expecting is for it to stay about where it is right now. We're starting to see stability in the market, which means it thinks that the war is going to be over fairly soon. But here's the problem. The Russians have apparently, we don't know for sure, but have apparently put some of their nuclear warheads into some type of offensive state. And what we're seeing is that the Ukrainian people are fighting back, and the Russians are not making a lot of progress anymore. So I think here's the interesting thing. Remember that the stock market is always looking 3 to 6 months into the future, sometimes as long as 12 months into the future. And I think that in this war in the Ukraine, it could literally go either way. The Ukrainians so far have held up very, very well. And the Western European countries, the NATO countries, are starting to accelerate from a microscopic level of support for the Ukraine. They're slowly making it higher. In other words, they're sending tens of millions of dollars of military equipment into the Ukraine. But the Ukrainians need armies, and they need billions of dollars, not tens of millions of dollars of new equipment. So they can still be crushed by the Russians. So that would then put us back into the mode where we were in the middle of last year. On the other hand, if the Russians don't escalate by using nuclear war or even more troops moving into the Ukraine, and they basically end up taking over maybe just the 2 eastern provinces or parts of the Ukraine, but Kiev is still independent, then we might see a significant rally in the market, because that would be very, very bullish. Now, the severe and swift with massive repercussion sanctions that were put on were really nothing. Okay, in the final analysis, they were nothing. The U.S. imported more Russian oil last week than it did the week before. That shows you how ridiculous it is. Now, my understanding is the most severe sanction was that Putin is not allowed to use the 2-for-1 BOGO issue at the Burger King. So that'll really hurt him a lot. But being serious, it's really not a lot. They're not doing anything that really severe. Germany Europe is shipping in more Russian oil than a month ago. So they're saying, oh, don't you do anything. We're not going to let you use that BOGO coupon at Burger King, but hey, would you ship us some more oil and let us send you hundreds of millions of dollars and maybe even billions of dollars to support your war effort, but no BOGO coupons at Burger King. You see what I'm saying? So it's like, what? Where's the disconnect here? But nonetheless, I think we're going to see increased sanctions. Maybe we'll actually get to severe and swift with massive repercussions. We haven't got there yet. It's been trivial so far. So the market could go either way based on the Ukrainian situation. Gold spiked up, and then they said, and came right back down and actually moved to the lowest level in a week. after the invasion. So we're back, I think, and what I'm saying is in all of these markets, we're more back to the underlying fundamentals, and the Ukraine situation as it stands as I'm recording this Sunday morning is not affecting the market. Now, I think there could be a lot of effects of the market going forward, and typically, wars are very bad for markets. They're very bad for the stock market. They're bad for the economy. I mean, it helps, defense contractors, but it doesn't help Walmart. Let's put it that way. So it doesn't help average people. But right now we have to stay focused on the underlying fundamentals because the market is trying to get back to the underlying fundamentals, inflation, Fed policy, all that kind of stuff, and not think about the Ukraine. So we will have to watch this very closely, although the Ukraine's obviously going to be a big factor. Our gold key indicators, pretty neutral. This one's clearly bearish, clearly bullish, choppy. So let's call gold neutral, but we'll come back to that later on the fully paid up section. Crude oil spiked up and then came down, and just like gold, it kind of moved to a lower low than it had been for the beginning part of the week. So oil is struggling, but I think it's going to continue to struggle at a stable level, Once, if the Ukrainian situation resolves itself, we'll start to see a bull market again in crude oil. But right now, people are going like, hold it. Now, one of the bullish factors that's going to pop up is that we're going to see more demand for Middle East oil and American oil and less from Russia. At least that would be the logical thing to do. You don't buy oil from a person who's threatening to invade you. That just seems kind of stupid to me, but that's what everybody's doing. So we're going to see a shift in the supply of oil and the demand of oil. And Bitcoin, realistically, you can see the purple predictor has been very strong. It's really become a clone of the stock market. And so I'm looking at this of being slightly bullish as it follows the stock market to higher levels. All right, thanks, freebies. Love having you here. Fully paid up members, hang on just 1 second. Listen, in these times of war and inflation and pestilence, we've got the four horsemen romping across the world today. You need to be a subscriber to Wall Street Winners to get trades on how to protect yourself and how to make money from all of this going on today.